We see hundreds of tax returns that are filed by real estate investors, and there are so many different errors that we run into. And so today I wanted to share my top 20 errors that I see on real estate investors' tax returns that you should watch out for your own. Hey, my name is Matt Bontrager, and for those of you that don't know, I'm a CPA and I run a firm called TrueBooks that specializes in tax preparation and tax planning for real estate investors and small business owners. And so today I want to share with you the top errors that I see on real estate investors' tax returns that ideally we turn around and help them with, but hopefully this video will help you avoid some of those pitfalls too. All right, so let's jump in. The first error that I want to talk about is reporting a short-term rental on Schedule C over Schedule E. For those of you that file rental real estate on your tax return, you're familiar to seeing Schedule E where you place your rental properties. That's where the activity gets reported. Back when short-term rentals were first really popping up and there was a lot of debate where they should be reported on the tax return, now with more guidance, we understand where that goes. Too many tax preparers that aren't versed in the real estate space just think automatically that because a short-term rental can operate more so like a business, they automatically throw it to Schedule C. Long story short, Schedule C will give you better tax benefits in the sense of if you have a W-2 income, you're going to be able to utilize, let's say, a loss that your rental generates, and it's going to go against your W-2 income if you put it on Schedule C. But the problem is most people that have short-term rentals still should be getting Schedule E treatment, which won't necessarily give you those benefits. And so although it's an error, clients like it because they're going to get better tax savings, but what it does is potentially open you to a higher risk of audit. So first error, filing short-term rentals on Schedule C instead of Schedule E when they need to be Schedule E. There's times that it can be Schedule C, but most of the time it's Schedule E. Now, the next error is going to be not taking any depreciation expense. Depreciation expense for us real estate investors is the Mac Daddy of deductions because it's a large deduction that's a non-cash expense. So my property may generate $6,000 of net income, net operating income, right? Rents received minus any expenses, property taxes, mortgage interest, and let's say I cash flow $6,000. Well, then I get a depreciation deduction that let's say is $20,000, and that would bring me to the negative or into a loss position. And the problem is we still see a lot of tax returns that don't even have a depreciation expense. So if you notice your tax return, your rental activities don't have depreciation expense, something to question and something to ask your tax preparer or find a new tax preparer over. Next is in-service dates for your properties. When you report a property on your tax return, you're going to have to put a date that the property became in service for that activity. The error that we usually see is people putting the date that they purchased the property instead of the actual date that it became in service. For example, if you buy a property in 2020 and then in 2024 make that a rental property, your in-service date is not 2020, the year you purchased it. It's going to be 2024, the year that you placed it in service. This is a whopper, and this is something that we kind of laugh at in the tax community because it's such an error, is simply classifying your down payment on a property as an expense on your rental profit and loss. Your down payment towards the property is going to get you depreciation expense because remember, when you buy the property, whether you put $1 down, you pay for it cash, or you finance the entire thing, you're still entitled to depreciation on the entire purchase price. The down payment doesn't matter in regards to what your deduction is. So a big error, putting your down payment on your P&L as if that's an expense. This is probably the most common error that we see, and this is recording capital expenditures as direct expenses on your profit and loss. This gets a little bit quirky, but for context, anything typically less than $2,500, such as repair and maintenance items, light bulbs, toilet seats, things like that, you will directly expense as an expense on your profit and loss statement. It would go under the category repairs and maintenance. But for something like a new roof or new flooring or new cabinetry, let's say this is $10,000, $15,000, $20,000, you don't put that directly in a repairs and maintenance line item so that you write it off directly. You have to do what we call capitalizing that expense, and then we take depreciation on it, potentially bonus depreciation and things like that. So one of the biggest errors that we catch is somebody that sends us a profit and loss statement, and we see a huge $80,000 repair and maintenance line item, and it's pretty uncommon to have repairs and maintenance items total $80,000. So usually what we know is they've put capital expenditure items in that line item, and we have to back them out. So general rule of thumb, if you have an expense less than $2,500, put that to your profit and loss statement. If you have something larger than that, flooring, roof, cabinetry, put that to a separate spreadsheet. Give us 3 pieces of data. Give us the date in which you put it in service, that you were done putting it in, such as flooring, again, cabinetry, things like that. Give us a description of what it is, and then give us the amount. And then we'll be able to take it from there. On your tax return, it's going to ask you what the amount of fair rental days was for your properties. One of the biggest errors that we see is simply tax preparers putting 365 in there, when in reality, they used the property, let's say, for a week of personal time, or they took it off the market as an Airbnb for a short amount of time, or they only had it rented for half the year. Make sure that your fair rental days is not just simply a plug of 0 or 365, and that it actually represents the amount of days that the property was rented. Now, similar to the fair rental day mistake, we also see personal use days are not being reported correctly as well. So similar to the fair rental days, make sure that you're putting the amount of personal use days that you're using the property on the tax return as well. Remember, it's fine if you use the property for personal use, you just end up ultimately having to prorate certain expenses because they're not entirely business related. For example, if you stay at the property for half of the month, half of that month's interest expense, let's say on the mortgage, is not deductible now that you've used it personally for half the month. But the other half is, because you've obviously still generated rental income from the other 15 days or so that you had it rented. So make sure that you're putting the amount of personal use days on there as well. Back in the Tax Cuts and Jobs Act that Donald Trump passed, there was a thing called qualified business income. And then there was something called the qualified business income deduction. It was basically a 20% shave off the top for small businesses. Well, your rental property can actually qualify for this tax treatment, and you can get essentially a 20% deduction there. And in order to do this, you have to pass certain tests so that your rental property qualifies as such. And the error that we see here is sometimes taxpayers will qualify for this deduction when their tax preparer didn't ask the right questions, and then they ultimately never got those savings because the tax preparer didn't prepare it the right way. So QBI, make sure that you're talking about it to your tax preparer if you have rental properties and you operate them yourself. This is a mistake that I've seen a couple times, and this is, I would say, a big one. If you look at Schedule E on your tax return, there is a column. There's A, B, C, A, B, C, and it's because each A, B, and C are meant for one single property. We have seen people group rental properties to one column on the tax return, and I can't express enough what a mess this is, what a mess it causes for the next tax preparer, what a mess it would be if you end up getting flagged for audit and you try to unravel that. But remember, ABC, each section is meant for one rental property. Do not group your rental properties to one column and one line item. Make sure that you're splitting them out so you show the detail for every single property. Similar to this concept of making sure each line item has its own column on the tax return, if you buy a multifamily property, let's say a fourplex, make sure that you don't put each unit on its own column as well. You just report it based on property. So if you have a fourplex, that is one property. You as an operator may have 4 little P&Ls within that property to see how each unit is being managed and see how each unit is performing. But at the end of the day, when it goes to your tax return, make sure that you consolidate all 4 of those P&Ls to one P&L for that property, and then that one P&L gets reported on your tax return in either A, B, or C, one column in its own. Now, this error has a little bit more complexity to it, but when you report a rental property on your tax return, you have to break out the building value and the land value. We see too many accountants using a general 80-20 or 90-10, when in reality, let's say land values could be 30, 40, 50%, obviously in some areas of the country. So my only advice here is make sure that your accountant is pulling a fair land value from some sort of property tax bill, county assessor site, or something that gives you a better insight as to what the actual land value is, instead of just saying, yeah, we use 90-10, 80-20, 70-30, something like that. For my real estate investors here that invest in syndications, such as apartment buildings where you just put 100, 200 grand in and you're a limited partner, one of the biggest errors that we see when it comes to rental real estate, because that is a form of rental real estate, you're just a partner in a bigger deal, is that when you get these losses that come back to you, because these property owners at the apartment level are doing the same thing, they're doing cost segregation, depreciation, is the losses that you get back on that K1, they're reporting that as non-passive. And 99.99% of the time, if you put money in a deal like that, you are passive. That's the whole point. You have a sponsor and a general partnership or a set of general partners that are running that deal and actively working on that deal versus you have just contributed funds and you get to sit back and ideally reap the benefit as an investor. Well, that is passive activity. And one of the errors that we see is sometimes preparers will take that K1 and label that as non-passive active and say, give you the loss against your W-2. When ultimately you shouldn't be getting that tax treatment and it ultimately opens you up to more risk. Now, you all have probably heard that with rental real estate, you get to depreciate the real estate. And if it's a long-term rental, it's over 27 and a half years. If it's a short-term rental, it's over 39 years, more of the commercial term. One of the biggest problems that we see is simply tax preparers taking short-term rentals and depreciating them over 27 and a half years and vice versa. So make sure that you look out for that on your own return. And if it's a long-term rental, 27 and a half, short-term rental, 39 years for the building value, right? We still want to cost segregate the smaller assets within that property, but the building value itself needs to be depreciated respectively between 27 and a half and 39. Now, for my real estate professionals out there, one of the best tax advantages that you have is materially participating in your real estate and taking these losses against your ordinary income. That's the overall strategy. Well, to do this, you have to materially participate in the projects. Let's say you have 5 rental properties. You technically have to materially participate in all 5 properties to utilize the losses that they generate. But let's say you only materially participate in 4 of them and 1 of them is out of town. You can make a grouping election to group these together as one unit, and sometimes tax preparers will group short-term with long-term, and that is a no-no. They each have their own grouping elections and they need to be grouped together and they can't be commingled. So something to keep in mind there. Now, this is an easy one, but gets missed a lot. For you to write off items, for example, under that $2,500 threshold, you typically need to make a de minimis safe harbor election. And all that is your tax preparer simply checking a box on your tax return. And then at the back of the tax return, that election page will show up. Checking your tax return to ensure that you're making that de minimis safe harbor election is really important to make sure that you're allowed to take these smaller deductions directly to the P&L and you don't have to capitalize them. Remember, if you have the option of writing something off versus depreciating it, either way, you're going to get the expense. But if you depreciate it, what happens later when you sell it? You're going to have to pay recapture tax potentially. So anytime we can take something as a deduction straight up, we want to over depreciating it. This next one really makes us chuckle in this industry because we're very familiar with what? Cost segregation studies. We work with firms that do cost segregation studies for our clients, which goes in and evaluates the property. I even made a video on this in one of the previous videos. Go check it out. We'll probably put the link in the description of what a cost segregation study is. We hear too many times that because preparers who don't handle real estate clients, they're not used to these cost segregation studies. And so they'll hint to certain clients at times that they feel that it's more risk to do one or that it's illegal to do one. And that in and of itself is just bad tax advice, and that's not true. These are very common amongst people in the real estate space. And so if you're watching this and you have real estate and you've never heard of one, or even worse, you've talked to your preparer about it and they tried to turn you off about the idea, it's definitely time to run to a new professional. There's nothing illegal or bad about doing them. For my business owners watching, you probably operate your business as an S corporation. It is common for us to say that you never want to commingle rental properties with your S corporation, which is very true. And the reason is because if you end up transferring out a rental property that your S corporation owns to another entity, let's say you want to leave it to your son, the problem is that becomes a taxable event the second you move that property outside of that entity. So my advice here, and the error that we see, is people that have taken down rental properties and they have them in their S corp, and then they shut them down because they think that they don't need the S corp anymore, or because it was a bad move to put the rentals in there. Well, by shutting it down, you're triggering that taxable event. And so the mistake that we see is shutting them down when in reality, you should just leave it up and consistently report the rentals while they're in there and just wait until the day that you sell or 1031 out of them. Now, you've probably heard of real estate professional status. There are 2 strict rules that you have to meet in order to call yourself a real estate professional. The first one is you have to spend at least 750 hours in the nature and business of real estate, whether that's managing your own portfolio, working within your own role in your business as a flipper, developer, wholesaler, something like that. But You can't be a W-2 employee working at a real estate brokerage and call yourself a real estate professional. Like I said, you have to be running your own business or running your own portfolio. Test number 2 is it has to be more than 1/2 of your total work time. And so you'll see that if you're a department store manager and you still want to claim that you're a real estate professional, it's likely not going to work, given that you'd have to work 4,000 hours a year and you'd have to work the majority of those in real estate. So one of the biggest mistakes that we see is that tax preparers will give clients the designation of being a real estate professional when in reality they simply are not. And you do run a risk because you get a lot of tax benefits potentially for being a real estate professional. But obviously, if you're not entitled to those benefits because you've been falsely claimed as a real estate professional, you could find yourself in some hot water. Now, while some of these errors don't necessarily increase the amount of tax you pay, they definitely open you up to more exposure for audit. And so having somebody in the business that prepares tax returns for similar clients to you if you're a real estate investor is very important and something you need to consider, even though sometimes the tax preparer around the corner may be cheaper at $150, $350 versus someone like my firm who we start at $1,000 and someone with a rental property could be $1,300 or $1,400 for that tax return. Well, you're paying for the experience to make sure that not only do you save the most amount of money on your taxes with tax planning, but also that it's being reported correctly and it's accurate so that ideally you can fly under the radar and having your return be selected because you have an erroneous error that could have otherwise been caught. And that's not to mention, there are some of these mistakes here that will cost you an increased amount in taxes. So when you couple that together as far as tax savings, cash back in your pocket with the increased risk and exposure for audit, if you ask me, it's way better to stick with a professional. That's the list that I have for the most common mistakes. And as always, if you find anything helpful here, please leave a comment below. And if you want me to cover anything else that you find interesting related to your own tax return or want me to cover as a real estate CPA, feel free to throw it in the comments and I'll see you on the next one.